This is Walter Coulter with Cornacopa. Today I'm going to be discussing why wealthy people use life insurance as an investment to grow and protect their wealth, along with protecting them and their loved ones. But before I get started, let me address the elephants in the room. You've heard of Dave Ramsey and Susie Orman. They say that you should never use life insurance as an investment and you should always buy term. Two words I don't really like to use is always and never. See, there is some room for term insurance sometimes, but this video is not about that. We're going to focus on building wealth. Now, let's go back in history a little bit and think about some of the times that life insurance has been used to build and protect wealth. You are familiar with Ray Kroc, who founded McDonald's, right? You're familiar with Walt Disney, that created Disney World and Disney and on and on and on. You're also familiar with J.C. Penney, right? In the Great Depression, the stock market crashed, as they sometimes do, and banks fell. So the economic markets were destroyed, but J.C. Penney had money sitting in his life insurance account. That money was safe, as life insurance tends to be. So he was able to use that money and keep the store going, pay his employees, and also he hired Sam Walton, who went on to found and build the empire of Walmart. So when you're looking at permanent life insurance, it makes sense to sit down first with the professional and make sure that you have everything in place. See, a lot of people, what they do is they make a move and they don't get an x-ray first. We believe that you should do an x-ray before you operate. Let me give you a story. We got the story of two trees, right? Now, it's cold and the winter is approaching, and there's a village and they need wood for cabins and for firewood. So they bring on Ralph and Reggie to go out and each cut down a tree and bring it back. Now, so the crowd is sitting there and they're watching these two guys run out into the forest. Now, if you can imagine two trees out in the horizon, and you see these two guys run to the tree, Ralph and Reggie get to the trees at about the same time. Now, what happens is Ralph disappears and you see Reggie climb up the tree. Now, as Reggie's climbing up the tree, the people are cheering him because they can see the progress, and people tend to do that. So they're cheering him, and then Reggie gets to the top and he starts pulling the leaves off the tree and he starts cutting the tree down from the top. Versus Ralph, you don't see, people start booing him and they are cheering on Reggie. As Reggie's cutting down the tree and pulling off the leaves, all of a sudden you hear this loud boom. And they look over and Ralph's tree is gone. And so they start running up and they see that Ralph and his team is pulling the full tree together and bringing it back to the village. Now it's obvious that Ralph's tree is going to be there first to help protect the village. So the moral of the story is to get advice before you move. We believe it makes sense to get an x-ray before you operate. See, so many people, when they put life insurance in place, and I'm talking about the people that sell it, most of them do it wrong. From what I see, a lot of people don't fully understand it. So it gives credence to the people that say just use term insurance. Now, if you've read the book by Tony Robbins, Money Master the Game, he talks about how to use permanent life insurance as an investment the right way. So that's what we're going to be discussing in this course, and we're going to go over some tips and give you some things that you should look out for. And those are the enemies to your money, the traits of a good investment, the tax triangle, and the phases of achieving a financial goal. And the enemies to your money are taxation, inflation, and the largest nation in the world, procrastination. See, these are the roadblocks that get in the way of building wealth, and you should be clearly aware of them. And the traits of a good investment are low taxes, low risk of loss, favorable rate of return, reasonable access / liquidity, and justifiable fees. It's amazing when you think how much goes into really planning out building wealth. And the tax triangle includes tax now, tax later or defer, or tax never. See, it's not what you make or even save, it's ultimately what you get to keep and what you get to use on your lifestyle. And so many people, when they're funding a goal, they don't think about how they're actually going to get the money out, and what the fees and taxes are going to be. And the phases of achieving a financial goal are contribution, accumulation, distribution, and sometimes transfer. See, when you're putting money away for the future, what you need to think about is what it's going to be like when you pull the money out. How much of it do you ultimately get to keep? And if something were to happen to you prematurely, who gets it? And who gets the money that you spent so long and the wealth you spent so long building? Does it go to Uncle Sam or to recklessness and probate, or does it actually get to go to the people that you love? So these are the areas we're going to address in this course in full detail. Let's go.